Preparing for a financial analyst at Exelon interview? You've reached Candy Mentor, and this video is for you. We'll walk through 20 key questions you're likely to face. For each question you'll see a sample answer followed by the key points to cover. Subscribe, like, and share, and drop a topic request in the comments. Question 1. Why do you want to work as a financial analyst at Exelon? I am attracted to Exelon because its financial decisions affect essential infrastructure, customer reliability, and the transition toward cleaner energy. As an analyst, I could combine modeling, variance analysis, and business partnering rather than analyze numbers in isolation. I am especially interested in understanding how operating performance, regulatory outcomes, and capital investment influence earnings and cash flow. Exelon's scale would also let me develop strong finance fundamentals while contributing to decisions with visible, long-term economic impact. While answering, connect your analytical interests to Exelon's regulated utility model, critical infrastructure, clean energy transition, customer impact, and the opportunity to support disciplined capital allocation and operational decision-making. Question 2. What do you know about Exelon's business model? Exelon is primarily a regulated utility company operating transmission and distribution businesses through utilities such as ComEd, PECO, BGE, and PEPCO. Its economics depend on serving customers reliably, investing in the grid, and recovering prudent costs through approved rate structures. That makes earnings more regulated and predictable than those of a merchant generator, although regulatory decisions, weather, operating execution, and customer trends still matter. I would analyze both financial results and the operational drivers behind them. Make sure to cover Exelon's utility-focused operations, regulated transmission and distribution businesses, customer service territories, rate recovery, capital investment, and exposure to regulatory and operating performance. Question 3. How would you build a financial forecast for an Exelon utility? I would begin with historical actuals and identify the utility's key drivers: customer growth, usage, approved rates, weather, labor, maintenance, storm activity, and regulatory adjustments. I would forecast revenue and expenses by business unit, separately model capital expenditures, depreciation, interest, and cash taxes, then link the statements. Finally, I would create base, upside, and downside cases and reconcile forecast changes to prior guidance. The model should explain business performance, not simply extrapolate historical percentages. In your answer, discuss revenue drivers, customer counts, usage, approved rates, operating expenses, labor, storm costs, depreciation, financing, capital expenditures, scenarios, and reconciliation to historical performance. Question 4. How do regulated utility rate cases affect Exelon's financial statements? A rate case determines how much revenue a utility may collect and how it recovers prudent operating costs and capital investment, including an allowed return on rate base. Approval can increase future revenue and earnings, while delays or unfavorable decisions may create pressure. Accounting may also record regulatory assets or liabilities when recovery or refund occurs in a different period than the underlying cost. I would model both the eventual economics and the timing of cash and earnings recognition. Be sure to mention approved rates, revenue recovery, regulatory assets and liabilities, timing differences, allowed returns, customer affordability, and how rate case outcomes affect earnings, cash flow, and forecast assumptions. Question 5. Walk me through how the three financial statements connect. Net income begins on the income statement and flows into retained earnings on the balance sheet and operating cash flow on the cash flow statement. I add back non-cash expenses such as depreciation, then adjust for working capital movements. Capital expenditures reduce cash and increase property, plant, and equipment, while debt issuance increases cash and liabilities. Ending cash from the cash flow statement must match the balance sheet, and total assets must equal liabilities plus equity. Focus on net income flowing into retained earnings and cash flow, depreciation and non-cash adjustments, working capital movements, capital expenditures, debt financing, and the balance sheet check. Question 6. What is rate base, and why is it important for a regulated utility? Rate base is generally the regulator-approved value of assets used to provide utility service, adjusted for items such as accumulated depreciation and certain regulatory balances. It matters because the allowed return on rate base is a major component of a utility's authorized revenue and earnings. A larger, prudently incurred rate base can support additional recovery, but spending is not automatically valuable. Regulators assess necessity, efficiency, and customer benefit before permitting recovery through rates. While answering, define rate base as the regulator-approved investment base, explain allowed return and depreciation recovery, and distinguish productive capital from unsupported or non-recoverable spending. Question 7. How would you analyze an unfavorable operating expense variance at Exelon? I would first quantify the variance against budget and prior year, then decompose it by utility, department, and cost type. I would determine whether the driver was volume, price, timing, weather, storm response, headcount, or a one-time event. Next, I would validate the explanation with operating metrics and responsible managers rather than assume the accounting classification tells the full story. I would summarize controllable versus uncontrollable items and update the forecast with clear management actions. Mention decomposing the variance by business unit and cost category, separating price, volume, timing, and one-time items, validating with operational data, and recommending corrective actions. Question 8. How does a capital expenditure affect Exelon's financial statements and valuation? A capital expenditure initially reduces cash and increases property, plant, and equipment rather than immediately reducing operating income. Over time, depreciation lowers earnings, while financing creates interest expense and debt obligations. For a regulated utility, the investment may also enter rate base and support future revenue recovery if regulators find it prudent. I would evaluate whether the project improves reliability, satisfies policy requirements, earns an acceptable return, and creates value after construction, operating, and financing costs. Discuss the initial cash outflow, asset capitalization, future depreciation, financing needs, rate base potential, regulatory recovery, returns, and the difference between accounting impact and economic value. Question 9. What financial metrics would you monitor for Exelon? I would monitor earnings and adjusted earnings, operating cash flow, capital expenditures, free cash flow, debt to capital, interest coverage, and liquidity. Because Exelon is regulated, I would also track rate base growth, allowed versus earned returns, regulatory recovery, customer counts, usage, reliability metrics, and storm-related costs. The right interpretation comes from connecting financial outcomes to operating drivers. For example, higher CapEx may pressure near-term cash flow but support long-term rate base growth and service reliability. Be sure to include adjusted earnings, operating cash flow, capital spending, debt ratios, interest coverage, rate base growth, allowed versus earned returns, reliability, customer growth, and regulatory performance. Question 10. How would higher interest rates affect Exelon? Higher interest rates would generally increase the cost of refinancing debt and financing new capital projects, which could pressure earnings, cash flow, and interest coverage. They can also raise the discount rate used in valuation and make customer affordability more sensitive in rate proceedings. I would review Exelon's maturity schedule, fixed versus floating exposure, liquidity, and hedging. I would also assess whether regulators permit recovery of prudently incurred financing and operating costs over time. In your answer, cover refinancing costs, variable rate exposure, discounted valuations, customer rate affordability, capital program economics, liquidity, and potential offsets from regulatory recovery or hedging. Question 11. How would you assess whether Exelon's capital program is financially attractive? I would assess the project's strategic purpose first, such as reliability, grid modernization, compliance, or customer growth. Then I would evaluate construction costs, schedule, operating savings, financing requirements, expected rate-based treatment, and recovery timing. I would calculate returns and cash flow impacts using an appropriate regulated utility discount rate, while testing cost overruns, delays, and lower utilization. A project can be strategically necessary even with modest direct returns, but its regulatory and customer economics must remain credible. Focus on project purpose, timing, construction risk, expected reliability or compliance benefits, cost assumptions, regulatory treatment, weighted average cost of capital, sensitivity analysis, and customer value. Question 12. What is the difference between generally accepted accounting principles earnings and adjusted earnings? Generally accepted accounting principles earnings follow standardized accounting rules and provide the primary basis for comparability and reporting. Adjusted earnings remove selected items management considers unusual, non-recurring, or less representative of ongoing operations, such as certain regulatory, restructuring, or impairment effects. I would always understand the reconciliation rather than accept the adjusted label automatically. The best analysis uses generally accepted accounting principles for discipline, adjusted results for operational trend insight, and clear judgment about whether excluded items could recur. Mention generally accepted accounting principles consistency, management adjustments for unusual or non-recurring items, reconciliation transparency, recurring versus exceptional economics, and avoiding over-reliance on adjusted measures. Question 13. How would you prepare a monthly management reporting package? I would begin by validating source data, mapping accounts consistently, and confirming close status with accounting. The package would show actuals versus budget, prior year, and forecast, supported by operating indicators such as customers, usage, reliability, labor, and capital spending. I would highlight material variances, explain root causes, distinguish timing from permanent changes, and update the outlook where necessary. Finally, I would provide executives a concise summary with decisions, risks, and recommended actions. Be sure to discuss data validation, actual versus budget analysis, key performance indicators, explanations, forecast updates, executive summaries, materiality, and tailoring detail to the audience. Question 14. Describe a time you found an error in a financial model. In a budgeting project, I noticed projected cash balances did not reconcile to the supporting debt schedule. I traced the issue to a formula that referenced prior year interest expense after a column had been inserted. I corrected the formula, recalculated the forecast, and quantified the impact on cash and coverage ratios for my manager. I then added a balance check section and reviewed key formulas independently. The experience reinforced that model controls are as important as analytical conclusions. In your answer, use a concise star structure, explain the control or reconciliation that exposed the issue, quantify the impact, describe remediation, and show how you prevented recurrence. Question 15. How would you use Excel in an Exelon Financial Analyst role? I would use Excel to consolidate operating data, build driver-based forecasts, analyze variances, and test scenarios. Functions such as SUMIFs, XLOOKUP, index match, and structured references help keep models flexible, while pivot tables support efficient reporting. I would include scenario switches, sensitivity tables, reconciliation checks, and clear documentation. Before sharing results, I would test formulas, compare totals with source systems, and review unusual movements. The objective is a controlled model that others can audit and update. Mention structured models, SUMIFs, XLOOKUP or index match, pivot tables, scenario switches, sensitivity tables, error checks, data validation, documentation, and balancing speed with control. Question 16. How would you evaluate a forecast when weather is unusually mild or severe? I would separate weather-driven effects from underlying customer and usage trends. I would compare actual conditions with historical normals, estimate the associated demand and revenue variance, and assess offsetting costs such as storm response, maintenance, or purchased power where relevant. Then I would produce a normalized forecast alongside the reported outlook. I would avoid extrapolating an unusual month indefinitely, but I would update assumptions if weather patterns affected the broader planning period or exposed operational risks. Discuss separating weather-sensitive usage from underlying demand, comparing normalized conditions, assessing revenue and expense effects, using historical relationships, and updating scenarios without overreacting to temporary conditions. Question 17. What risks are most important for a financial analyst at Exelon to monitor? I would monitor regulatory and political risk, extreme weather, grid reliability, cyber and physical security, construction execution, interest rates, liquidity, environmental requirements, and workforce availability. Customer affordability is also important because higher bills can influence regulatory outcomes and collection trends. I would translate each risk into financial effects, including revenue timing, operating costs, capital requirements, or credit metrics. Strong analysis should show probability, potential magnitude, early indicators, and practical mitigation rather than simply list risks. Cover regulatory decisions, cyber and physical security, grid reliability, extreme weather, project execution, interest rates, liquidity, environmental requirements, workforce, and customer affordability. Question 18. How would you explain a complex financial result to a non-finance stakeholder? I would lead with the conclusion and explain the business driver before discussing accounting detail. For example, I might say that expenses exceeded budget primarily because storm restoration required additional crews, materials, and contractor support. I would quantify the impact, separate temporary from recurring costs, explain any expected regulatory recovery, and state the forecast implication. I would use a simple chart or bridge when helpful, then confirm the stakeholder understands the decision or action required. Focus on starting with the conclusion, using plain language, linking the result to operational drivers, quantifying material impacts, avoiding jargon, checking understanding, and clarifying the required decision. Question 19. Tell me about a time you managed competing deadlines. During a reporting cycle, I had to complete a variance analysis while supporting an urgent management request. I listed the deliverables by deadline, decision impact, and dependencies, then completed the information needed for the executive request first. I communicated the revised sequence to my manager and reserved time for review rather than compressing quality checks. Both deliverables were submitted on time, and I created a reusable data template afterward. That experience improved my prioritization and communication under pressure. Use a specific example, describe prioritization by materiality and deadline, communicate early, protect review time, maintain accuracy, and explain the outcome and lesson learned. Question 20. If Exelon's revenue beat budget but cash flow declined, how would you investigate? I would bridge the difference from revenue and net income to operating cash flow, then inspect working capital, collections, regulatory assets, storm payments, interest, taxes, and timing items. I would separately review capital expenditures, debt activity, and other investing or financing uses of cash. A revenue beat may not convert to cash if collections lag, revenue is non-cash or deferred, or costs were paid earlier. I would quantify each driver and determine whether the decline is temporary or structural. Be sure to analyze working capital, collections, regulatory balances, capital expenditures, storm costs, interest, timing differences, non-cash revenue, and reconciliation from earnings to operating cash flow. If you are still with us, congratulations! You are much ahead of the rest and serious about preparing for your interview. We hope we were able to add value to your preparation and create some helpful content. Do not forget to like and share this video. Your small act can do great things for us.